everyone, and welcome to Financial Accounting. In this video we're going to go over Chapter 2, which is about analyzing transactions. So basically we're going to see how accounting is done formally compared to what we've been doing in Chapter 1. In Chapter 1 we got an idea about the accounting equation and the different accounts within the accounting equation. We also got some idea about the different financial statements. In today's chapter, we're going to see the formal way of accounting and how it's done, using what we call it the T accounts or simply the accounts. So we're going to get to know a new concept, which is debit and credit, and how it works, and how we can increase an account and decrease it. So accounting systems are designed to show the increases and decreases in each accounting equation element as a separate record. This record is called an account. So we'll see what or how we can present the account on what we call it a T account. An account in its simplest form has three parts. It has its title, which is the name of the accounting equation element recorded in the account. We've seen it last chapter where we've seen like cash, we've seen accounts like capital, like fees earned, wages expense, land, supplies. All these accounts are different accounts within the accounting equation. Another part of the account is a space for recording increases in the amount of the element and another space for recording decreases in the amount of the element. Because think about cash, for example. There are things that would increase the amount of cash and there are things that would decrease the amount of cash. So there's a separate space where we record these increases and another space for recording the decreases in the amount of cash. So what we've seen last week was this kind of presentation where we have the assets, liabilities, and stockholders' equity, which is basically the accounting equation that we know. And within assets, we had three examples of assets, which we call them accounts. So we have cash account, we have supplies account, and we have the land account. Under liabilities, we only got to know the accounts payable, and under stockholders' equity, we have the common stock. And then we have other accounts that would have an impact on the common stock, which are fees earned, which is considered to be a revenue. And all these expenses and these impact, they have a negative impact on common stock. The revenues and expenses, we call them income statement accounts because basically they belong to the income statement. And we also have the dividends account, which has a negative impact on common stock. So how we presented this, we just went transaction by transaction, and we've seen how each transaction had an impact on these accounts. And one thing that we learned is that the account balance or the accounting equation should always be balanced. And at the very end of the month, which is the period that we were doing our accounting transactions, everything that we had on the asset side should match what we have on the liabilities and stockholders equity side. So in other words, the accounting equation should always be balanced. The bad news is that this is not how we do accounting. This is too simple for accounting. In accounting, we have to use a different format, which we call it the T account. So we'll get to know how it works, and we try to take care of each account separately, and we'll create two sides for it, or two spaces, and we'll get to learn about these two spaces, which we call them the debit and the credit. So the account form that follows is called a T account. So what we have here, as you can see, this is what we call the T account because it resembles the letter T. You can see here, it's a letter T and it has a left side and a right side. This left side is always called the debit side and the right side is always called the credit side. So it doesn't matter which account you're talking about. I want you to always remember that the left hand side is the debit side, the right hand side is the credit side. And we always write the title of the account that we're dealing with on the top of this T presentation. So let's say it's cash, we write cash and then we record numbers on the left side, we record other numbers on the credit side, which represents the change in the amount of cash. Let's say we have accounts payable, so again the name here would be accounts payable, and then the left side we record the transaction that affected the accounts payable on the debit side and the other transaction that affected the account on the credit side. we'll get to know how these would affect each account. One thing I want you to pay attention to, we only use accounts. We cannot have a T account that has the title assets or liabilities or equity. This is like more a general classification, but in the T accounts we use specific accounts like cash, supplies, land, accounts payable, capital, any form of expense, fees earned, which is a revenue, or dividends, or any of these accounts that we used in chapter 1. So let's use an example for cash. Cash is an asset. I hope you remember that. Cash is one of the most important assets that any business should make sure that they have enough of. So see here we have the T account, and we write the name cash. And then on the debit side, which is the left-hand side, remember now, when we say debit side, this is the left-hand side. Since this is cash, we're recording things that increases, or things that increase the value of cash. And on the right hand side we record things that decreases or decrease the cash balance. So everything that's recorded here are things that increased cash, and everything that recorded on the credit side, on the right side, this is what we call it, or this represents the things that would decrease cash. So one more time. Things that are recorded on the left hand side, this is the debit side. When it comes to cash, these are transactions that increased the cash balance. So remember when Chris Clark, who's the main owner of the business, which is called Net Solutions, I hope you remember that, he invested $25,000, so he brought to the company $25,000 that increased the value of the cash in the business. Also when they had some kind of service revenue and they earned some fees for the services, the earned fees, so that was also received in the form of cash and increased $7,500. On the credit side, these are the payments that the business made. So we had $20,000, $3,650, $950, $2,000. So how we can calculate the balance for the account? It's very simple. We add the debit side, we add the credit side, get the difference, and record it on the larger side. So just a simple math here. If we do the math, the total of the debit side is about $32,500, and the total for the credit side, let me do the math quickly, this is about $26,600. Get the difference between them, it's going to be the debit side larger than the credit side, and we record the difference on the larger side, which is the debit side in this case. So $5,900 is the larger side, that's the balance for cash. So if I go back to the previous slide here, you see that the balance for cash was $5,900. So instead of having plus and minus that way to record the ending balance of cash at the end of the period, end of the month, what we do is that we have debit side and credit side. The debit would be the increases, the credit would be the decreases, and then we record the balance at the very end based on the difference between the debit side and the credit side. So, recording transactions in an account must follow certain rules, and that's the thing I want you to remember here. Increases in assets are recorded on the debit side, which is the left-hand side of the T account. Decreases in assets are recorded on the credit side, which is the right side of the same account. The excess of the debits of an asset account over its credit is the balance of the account at the very end of the period. So again, when we say the excess, basically it's the difference between the debit and credit side, or what we have on the left hand side and what we have on the right hand side. We get the difference, and then typically we are going to record this difference and the larger side, or on the larger side. So the balance of the cash account in this case of $5,900 is the excess of the debits over the credits, and it's calculated as follows. As I said, the debits were $32,500, the credits were $26,600. As you can see here, $32,500, the credits are $26,600. The difference between them is $5,900, and that's the balance of cash as of the end of the month or the period, which is November 30th, year 3. So this is the, like I would say, this is the basics of debit and credit. So I really want you to make sure that you understand where we're going now, because it's going to be all built on this concept. So make sure that you are getting this idea In accounting, there's something called chart of accounts, and every business has its own chart of accounts. What is a chart of accounts? It's basically a list of all the accounts used in the business. So a group of accounts for a business entity, we call it the ledger. Okay? So in the ledger, we have all the accounts used. The ledger is more specific because we record all the balances for the transactions or for the accounts that we have in the ledger. So a group of accounts for a business entity is called a ledger. Remember that. So in the good old days, it used to be like a big book where we have a page for each account. This book, we used to call it the ledger. In more simplest form, we can use an Excel file, and then we have different tabs, and each tab of this is an account, and that Excel file we can call it the ledger. So a list of the accounts in the ledger is called a chart of accounts. Okay, so the chart of accounts is the list of accounts in the ledger, all the accounts that the business uses. So if we remember again, for the business that we have, Net Solutions, the chart of accounts they have cash, they have supplies, they have land, they have accounts payable, they have dividends, they have capital, they have all the different expenses like the wages expense, rent expense, and so on. So if we write them in a list, again, we don't need the balances. Just the list by itself, it's called the chart of accounts. If we have the balances, that's a different statement that we're going to talk about later. So the accounts are normally listed in the order in which they appear in the financial statements. So the balance sheet accounts are typically listed first. So try to remember, what are the balance sheet accounts? Any account that's related to the accounting equation, we call them the balance sheet accounts, which are assets, liabilities, and stockholders' equity. So in our case here would be cash, supplies, land, accounts payable, and capital. These are the balance sheet accounts, and we usually start with these accounts in the ledger and in the chart of accounts. And then we have the liabilities, like accounts payable, and then the stockholders' equity, which is the capital. And then we add the income statement accounts. So the income statement accounts are then listed in the order of revenues and expenses. So we start with fees earned, and then we list our expenses. So one more time, what are assets? These are resources owned by the business entity. So these are the things that the business owns. How about liabilities? These are obligations or debts owed to outsiders, which we call them creditors. People who lend us, we call them creditors. How about stockholders' equity? It's the stockholders' right to the assets of the business. Stockholders' equity represented by the balance of common stock and retained earnings accounts. So there are two things that would, when we combine them together, would represent the stockholders' equity, which are common stock and retained earnings. Common stock is the contribution by the owners. Retained earnings, these are the income or the earnings that has been retained in the business, after, of course, paying all the dividends and incurring all the expenses. So what's a dividend? It's basically the distribution of earnings to stockholders. So out of the earnings, like if you think about any business, what they care at the very end, they make profit, and this profit should be distributed to the shareholders. How about revenues and expenses? Revenues are increases in assets and stockholders' equity as a result of selling service or products to customers. And this is the purpose of any business, is that they want to generate revenue by selling their product or providing their services to others. How about expenses? These result from using up assets or consuming services in the process of generating revenues. So in order to be able to generate revenue, you have to incur some expenses. And that's how it works. And if you think about any kind of business, that's very typical. They have revenues and they incur expenses to be able to be successful. So here's the chart of accounts for Net Solutions. We have balance sheet accounts, and you can see here under assets we have cash, accounts receivable, supplies, prepaid insurance, land, office equipment. Under liabilities we have examples of accounts payable or something called unearned rent. This is when somebody pays me rent in advance. Like let's say I'm a landlord and somebody pays me in advance. I don't own this yet because they didn't use the facility or the property yet. So because it's paid in advance, it's considered to be a liability. Until they use it, then I would earn this revenue or this rent, and it would be rent revenue. We also have stockholders' equity, things like common stock, retained earnings, dividends. And then for revenues, we've seen fees earned. In future chapters, when we start talking about merchandising businesses, we're going to see like revenues would be sales or sales revenue. And then for expenses, we have wages expense, supplies expense, rent expense, utilities expense, miscellaneous expense. And anything that we incur in the form of an expense would fall under expenses. Alright, so let me stop here. In the next video, we're going to go over the double entry accounting system, which is a very important concept. And again, I consider this chapter is very important for your understanding of our future topic.